discounted dividend valuation. Okay, so the contents as shown in your curriculum, there's an overview, introduction, then we'll talk briefly about present value models. This is a quick recap of what you should already know. Then we'll talk about the dividend discount model, then about the Gordon growth model. We'll talk about different kinds of multi-stage dividend discount models, and then finally talk about how we figure out growth rates. Okay, first a basic introduction. So I'll just read this and explain it. It's a core point that you need to be aware of. This is actually an introduction for, in general, discounted cash flow based valuations, where you are effectively taking cash flows and finding the present value. This is the most fundamental way in which you come up with the valuation of financial assets. Okay, so principles behind discounted cash flow are simple. Applying the theory to equity valuation can be challenging. So 4 broad steps are, so first we need to choose what discounted cash flow model we are using. So the point here is that we might have models based on dividends. We might have models based on free cash flow to firm, free cash flow to equity. We might have a model based on residual income. So we need to figure out which model. Then for that model, we need to forecast the cash flow. Okay, so it sounds simple in theory, but in practice, coming up with these cash flows can be tricky. Then how do we come up with the appropriate discount rate? Okay, so again, theoretically, it's not too difficult. If you are looking at cash flows that are going to the entire firm, then you use WACC, which is for the entire firm. If you are using cash flow to equity holders, then you use cost of equity. You need a model or methodology for coming up with a discount rate. Then you need to estimate the rate and then apply that rate to the cash flows. So hopefully you knew all that. If not, then we should be concerned. Okay. Now I think if anybody can't, this is just a warm-up. If you can't do this, then you should think again about doing the exam in June. Okay. So if an asset has an expected cash flow of 100 in 1 year, 150 in 2 years, 200 in 3 years, the value today, just warm up real fast. Okay, so everybody should be able to do this. 0, 1, 2, 3. Obviously, for throughout this equity course, you should have your financial calculators. Many of you might not have used it for a while, so think of this as a quick opportunity to remember how to use the cash flow register. If you don't remember, I can give you a link to my calculator tutorial. Okay, so there is 100, 150, 200 all discounted back at 10%. So what's the answer? 365. Okay, so all this discounted at 10%. So this is just your warm up. Okay, so now this is a very testable item. This whole reading mostly is based on discounting dividends. So the broad term is the dividend discount model. A very testable item is, when do you use the dividend discount model? Okay. Okay, so now here is a classic response. The response is stable dividends. How many people agree with that response? So the question was, when is it appropriate to use the dividend discount model to value a share? Okay, so yeah, it's right there. So this is critical, and you need to know this very well. It is a little more subtle than you might imagine. The company is dividend paying, so that's obvious. It's hard to use the dividend discount model if you can't project the dividends. Okay. The second is, the board of directors has established a dividend policy that bears an understandable and consistent relationship to the company's profitability. Okay, now I'm going to hold off for a couple of minutes on explaining this, and I'll see whether you really understand it. Right now I want you to read it a couple of times and see if you can internalize it and see if you can apply it on the next question. And then the final point, which should be a little more intuitive, is investor takes a non-control perspective. So if you have a non-control perspective, you are buying some shares in, say, a stock called FFC. If you have a non-control perspective, you are just getting dividends and you can value that share based on the present value of dividends. So remember these three terms: non-control, the company is dividend paying, and understandable and consistent relationship between dividends and the profitability. So based on what you've learned, let's figure whether you can apply the DDM to either of these companies. Okay, so you have two companies. Coke has a very stable dividend. Okay. HRL has a dividend also, but it's been changing. So the question is, let's take one at a time. Can you apply the dividend? Is it sensible to use the DDM over here? Doesn't it have a stable dividend? Yeah, so the point here is, one of the items on the previous slide was that there should be some relationship, or the investor should be able to understand that there is some relationship between profitability and the dividends being paid. Here, since 1994, there's just been a dividend of $1 no matter what the earnings are. Okay, so the dividend discount model does not make sense over here. Okay, it's not giving you a sense for how the earnings or the profits are changing for Coke. But for HRL, if you see, it's not perfect, but if you look at just the compound growth of EPS, of the earnings per share, from 1992 till 2006, and then you also look overall at the growth of earnings, if you actually do this on a calculator, you will notice that over these 14 years or so, in general, there is a similarity between the growth rate of earnings and the growth rate of the dividend. So here the DDM model does make sense. So it pays dividends if you are taking a non-control perspective, and if you can see a relationship between earnings growth and dividend growth, even though the payout, so the payout ratio is roughly, so there's a stable payout ratio of sorts. So here you can use the DDM. Now this you might not have fully gathered in level 1. So the incremental knowledge so far from level 1 is that in a company like Coke, even though it's paying a stable dividend, but you cannot apply the DDM. Alright. So next, in this particular reading, you are given a blurb on when to use free cash flow and when to use residual income, even though they are full-fledged readings on these later. But in your equity section, very likely you will be tested on where to use which model. So I think this slide also is significant. So generally use free cash flow, and at this point we won't distinguish between free cash flow to equity and free cash flow to firm. We'll do this in the next reading. So use this when the company is not dividend paying. When the company is dividend paying, but dividends significantly exceed or fall short of free cash flow to equity. So the Coke example, for example, if the Coke, you could use free cash flow based valuation. The company's free cash flows align with the company's profitability within a forecast horizon in which the analyst is comfortable, and you take a control perspective. Why does the control perspective matter, or why is it useful? You can change dividends. Okay, so you can maybe make the company more efficient. Okay, so memorize these 4 bullets, and then there'll be a sub-categorization between free cash flow to equity and free cash flow to firm in the next reading. Okay, residual income, we talked briefly about this in corporate finance, and then there's a full reading on this later in equity. You use this when the company is not paying dividend and an alternative to a free cash, as an alternative to a free cash flow model. Is there any requirement that you should only use one model? No, so you use multiple sensible models and then figure out your appropriate price. The company's expected free cash flows are negative within your analyst's comfortable forecast horizon. Okay, so we were having a discussion earlier about how do you forecast, how do you come up with a price for a company with negative cash flows in the foreseeable future. So answer is one option is to use the residual income model. A full reading on this coming up. Okay, so now this is a quick refresher. I won't make you do this. I'll assume that you either know this or just need a quick reminder. Suppose that you expect, I'm not sure how to pronounce this, Carrefour or Carrefour, depending on where you're from, okay, to pay a 110 dividend next year. You expect the price of CA stock to be this in 1 year. The required rate of return is 9%. What is your estimate of the value of the CA stock? This word is important. Why do they talk about value as opposed to price? So are you figuring out the price or the value? Yeah, so you are trying to get your estimate of the value, which isn't necessarily the actual intrinsic value, but you will notice this distinction over and over, so get used to it. Whenever they say value, that is sort of your estimate of the value, which will invariably be, or most often be, different from the price. So how do you do this? So it's D1 plus the price after year 1 discounted back 1 period. So this is basics from level 1 equity. For the next 5 years, the annual dividend is given. In addition, the stock price is expected to be 40 in 5 years. So you just take D1 discounted, D2, D3, D4, D5 plus discount the price after 5 years. So I won't even do this because I hope and expect that you know how to do this. Okay. Assume stylized growth pattern. Okay, so now the question is, how do you deal with future dividends? Obviously, when you come up with the value today, you need to figure out the present value of all future dividends. So you can't just keep discounting back 1 million dividends. So what do? You assume a pattern. What is the simplest pattern that we might assume? This is with the Gordon growth model, where we say that D1 is, say, $5, and then it is growing at a rate of 2%. Okay, so is this a stylized pattern? So you've established a pattern. What's this pattern called? This is a growing perpetuity. You know how to come up with the present value of a growing perpetuity. So this is easy. Another strategy that you've seen before is 2 distinct stages of growth. Sometimes in textbooks you have seen this as supernormal growth. So you say, okay, for a few years, say 4 years, the growth is, say, 10%, and then after that the growth is 4%. Okay, so again you are assuming some pattern. Or you might have 3 stages of growth, which we will talk about later. Determine the dividends for a finite. The other method is you determine the dividends for a finite period, and then just after that either forecast the remaining dividends based on stylized growth, or you come up with a share price at the terminal point and discount that back. A quick reminder of the Gordon growth model. So let's see if you can do this real fast. So the manufacturer of paper and plastic packaging for both consumer, so this is Sonoco. Okay. Sonoco appears to have a dividend policy recognizing sustainable increases in the level of earnings. So what does this phrase tell you? Yeah, so basically this is saying that DDM model is, so if you see this in a long case study, here it's obvious because it's on the chapter on dividends, but on the exam it might not be so obvious. So when you see this phrase, that's a catchphrase saying that use DDM, or you can use DDM. Okay, so anyway, they are also telling you that the dividend payout ratio is 40%. Okay, I want you to actually do this now. So there is a fair amount of stuff that is a recap from level 1. Let's see you do it. So does anybody have an answer? Yeah, so the answer is 26.8. This is example 5 in the curriculum. So what is the discount rate that they have actually done for you over here? So the discount rate is 10.4%. The basic DDM formula, notice that we are saying value and not price. Okay, so that's what you think the value is. Okay. Very often they'll ask you to find a value and then compare that with the stock price and ask you whether it's overvalued or undervalued. Okay, so the value is D naught into 1 plus G. So make sure you don't make that old mistake of just using D naught. You need to use D1 divided by R minus G. So we have a D naught, so that is 1.04 multiplied by 1.06, that's our growth rate. The discount rate is 0.101 minus, we are assuming a growth rate of 0.06. Okay, and that will give you the answer. So nothing new, just something you need to be on top of. And then they actually tell us after that that the actual stock price is 30. So clearly this, what will you do with the stock? Either sell it or short it or do nothing if you don't have it. Okay. Now, I don't think you were hit with this in level 1, but what is it possible for a company to have negative growth? Dividends are going down. Okay, what do you think you can use the dividend discount model if G is negative? Answer is you can. Okay, so this might seem a shade counterintuitive, but the exact same formula you can use. So if you notice, the value is equal to D1 over R minus G. Let me just do this for you. So what is D1? 4.25. What is the discount rate? The required rate is 12%. So make sure you read it well. So that is the growth rate. So R is 0.12 minus, what's the growth rate? Minus 0.1. So I'm teaching my kid in class 6 this stuff. When you do minus a minus number, what do you get? Okay, 4.25 divided by 0.22. Notice that the denominator becomes bigger, which reduces the overall fraction, which is what you might expect if dividends are slowing. If you don't like this or don't believe this, just get into Excel and create a column with all your dividends until they are more or less zero. Discount each dividend to the present, sum it up, and you will get this answer. What's the answer here? 19 point something. Okay, so the quick takeaway here, something you might not have seen before, is that even with negative growth, this works. But does the negative growth have to be consistent? To use this model, related, the earnings are going down, dividends going down, but the very simplistic assumption here is that the dividend will keep going down at 12%, which might be a little, seems a shade unrealistic. What if you can't make this assumption? Then what will you do? Then you will actually just do a brute force method. You will just figure out every single dividend you can and do it that way. Okay, so now what is the link? Just some basic points. Section 4.2 in the curriculum. The links among dividend growth, earnings growth, value appreciation, etc. in the Gordon growth model. Okay, the G in the Gordon growth model is the rate. Do you know what this rate is? Is it the rate at which? Yeah, so our general perception is dividend growth, but I think that's why I've taken this out. So there are so many things that you just do in level 1, and without understanding the concept, you can still pass, as evidenced by the size of this group. But in level 2, you need to get deeper in and truly understand this stuff. To summarize G, the growth rate in the Gordon growth model is the rate of value or capital appreciation. So G is really the rate at which you are expecting the stock value to grow. Sometimes this is also called capital gains yield. So if the stock is currently valued at 100 and G is 10%, you are expecting the stock price to go up at the rate G. Some textbooks state that G is the rate of price appreciation, so that is fine. This is fine if prices are efficient. So if value and price are the same thing, then you can say that G is the rate of value appreciation or the rate of price appreciation. Otherwise, according to the curriculum, the more technically correct and theoretically correct thing to say is G is the expected rate of value appreciation. So if there is mispricing, what does mispricing mean? That value and price are not the same. Then if there is mispricing, however, the actual rate of capital appreciation depends on the nature of mispricing and how fast it is corrected. And we did this earlier in the reading on return concepts. Another core point, and I just want to make sure you understand this, if the required rate of return is 10% on a given stock, and you are given that the dividend yield is 2%, can you just use this number and without doing any further detailed calculation, the capital gain yield, what is the expected capital gain yield? 8%. So as the stock year in, year out pays dividends as the stock grows, so 1 year from today, what will the stock price be, assuming efficient markets and no mispricing? So what will the stock price be if initially the stock price is 100, after 1 year how much will it be? 108. Now 1 year later, assuming the dividend yield is still 2%, the capital gain yield will be 8%. So the point is, the component of total returns stay constant if price tracks value. So if the price keeps going up, so if the price is fair, efficient, equal to value, and the price keeps going up at 8%, then the components of this return, 8% and 2%, they stay the same. Okay, so this is just a given. Hopefully you have seen examples of this. If not, then just take this as a given. Okay. Now, since we are talking about dividends, we should also talk about share repurchases, because an analyst who is doing dividend discount model needs to know what to do with share repurchases. When there are share repurchases, as I'm sure you know, does the investor benefit? The company is giving money back to the investor and buying back shares, so there are fewer shares. Why do companies like to do share buybacks? So actually, they can give extra cash back to the investor without setting a precedent for how much dividend to pay. So unlike cash dividends, share repurchases don't set a precedent. Evidence suggests, however, that over 2-year periods, repurchases are generally related to earnings. So what does this say? You can't exactly predict how much repurchase will happen when, but people who have studied this trend generally see that there is a link. If you look at a longer term horizon like 2 years, then you can see a link between repurchases and earnings. Okay, hard to predict the exact dates of repurchases, and at least theoretically, when there is a repurchase, shareholder is not any wealthier or any poorer. Why? Because when there is a share repurchase, what happens to the share price? It goes down, but that money in cash has been given to the shareholders. So why are we doing all this? If a company is doing lots of share repurchases, typically what are you used to so far with the DDM? With the dividend discount model, you are just used to looking at the cash dividend and discounting that back. Have you ever thought about what to do with these dividend repurchases, with share repurchases? Anybody wondered about that? Okay, so this is a good time to wonder about it. What you as an analyst need to do is you need to forecast. Obviously, dividend discount model is based on future dividends. So your definition of dividend should include both cash dividends as well as share repurchases. What is the logic? The logic is you hold a share of a given company. You want to see all future cash flow that is being generated because of that. So an analyst should forecast total earnings and then the total distribution to shareholders. Okay, so once you have estimated the total distribution to shareholders, the present value of that total future distribution to shareholders is used to come up with the value of the share. Logical? Okay, so this is important. Okay. Another use of this dividend discount model is to come up with an implied dividend growth rate. You will always have a stock price from the market, and we have seen this with an example from Intel in the earlier reading on return concepts. And anytime the same sort of example shows up more than once in the curriculum, that should immediately set up a flag that this is important. Okay, so that's why I'm repeating it, even though it's not difficult. A company has a beta of 1.1, risk-free rate is 5.6%, equity risk premium is 6. So in your sleep, you should be able to calculate the required return. Okay, the stock price is 40. So what is the value of the company stock? How will you do this? Again, notice the difference between value. If they've given the price, what is value? That's your intrinsic price. So do this quickly. You need to come up with R. The value is D1 over R minus G. So 2 into 1.05 divided by, what's R? So what is this? Value is equal to 29.17. So is the stock overvalued? Big time. Okay, now an analyst might, when he looks at this, he might say, okay, what is the market expecting the growth rate to be? How will you do that? So if this price were indeed accurate, an accurate depiction of value, then what would the growth rate be? So all you do then is plug in 40 is equal to 2 into 1.05 over 0.122 minus growth. So you solve for G. Yeah, okay, exactly. In the numerator, you also need a 1 plus G, and you solve for G, and you get G is equal to 6.86%. This illustrates another point. Even a 0.86% difference in your expectation about growth can have such a, this is more than a 33% difference in price coming out of only a 0.86 difference in your so this is 6%. Okay, so 1.86% difference in growth rate. But the point is, this is the implied growth rate, and if you as an analyst believe this is too high, then that justifies your thought that the stock is overvalued. Okay, now probably the first new concept of the day, the present value of growth opportunities. The way you can look at this is, for a no growth company, the earnings will be flat in perpetuity. Okay, so if you know that growth is 0, okay, so if there is no growth, then is it fair to say that all the earnings are paid out as dividends? So D1 is equal to E1. So what will the value of this company be? It will be simply E1, which is the same as D1, divided by the appropriate discount rate for this. So what we are saying is that the value of a company that has 0 growth is equal to E1 divided by R, given that you can say D1 over R, but that's the same as E1. Does it make sense for a company to reinvest dividends if it has no growth? Doesn't make sense. Okay, so then what we can effectively say that if the total value of a stock is depicted by V, for a stock that is growing, should it have a value that is more than E1 over R? It should, because if a stock that is not growing has a value, a company that is not growing has value E1 over R, then the value of a company that is growing must be E1 over R plus the present value of growth opportunities, right? So whatever value a company has over this number is the present value of growth opportunities. Okay. Now, another way of looking at this, that assuming price is equal to value, so if price is equal to value, then that P can be written as, so how can this be written? So the V can be written as P. So you can then write P is equal to E1 over R plus present value of growth opportunities. Now if you want to find the price earnings ratio, just divide this by E1. When you divide this by E1, what do you have? The E1 cancels out and you can have present value of growth opportunity over E1. So just simple mathematics. Now to give you a sense, a company like Google that has a beta of 2, so that's risky, a required rate of return, this 23 is a footnote that talks about how they use CAPM, high required rate of return, you are given the E1, you are given price, so this part E over R1, this part for Google is 115, but the present value of growth opportunity is very high. So actually 65% of the stock value, Google's stock value, is coming from the present value of growth opportunities. What about a company like McDonald's? Here only 28% of the value is coming from the growth opportunity. Does that make sense? That's logical. A company like Macy's that maybe is going down in terms of, so the growth is negative. Here the number is negative. Okay. So the question is present value of growth opportunity. So I'll just quickly go over it, and if there's still an issue we can look at it after class. Okay. What does PVGO stand for? Present value of growth opportunities. If a company is not growing, then what's the value of a company? So if the company is not growing, then the value is simply D1. It's a perpetuity then, right? So D1 over R. The D1 stays the same if the company is not growing. If the company is not growing, shouldn't dividend be the same as earnings? Right? So if dividend is the same as earnings, you can write E1 over R. So if E1 over R, just as an example, is 115, and the value of the stock is 332, then how do you explain the remaining 216? That 216 must be coming because of the growth opportunity. And furthermore, that must be, since that's the stock or the price now at time 0, this must be the present value of the growth opportunity. Okay. Now back to material that you might have seen. Do you remember what the justified or fundamental PE is? Okay, do you remember this? So do you remember that price is equal to D1 over R minus G? Okay, so then if you divide both sides by E1, what will you have? P over E1 is equal to D1 over E1 divided by R minus G. Just simple algebra, divide both sides of the equal to sign by E1. So this is your PE ratio. Is this the forward or the trailing? This is the forward PE. What is D1 over E1? This is simply the payout ratio. So generally you will see in the curriculum B is referred to as the retention ratio. So the payout ratio is 1 minus B. So what we are saying is the PE of a company, if you notice, is equal to 1 minus the retention ratio divided by R minus G. In other words, you can come up with the price earnings ratio of a company if you have an assumption about the retention ratio, about the appropriate discount rate, and about the assumed sustainable growth rate. The reason this is called a justified PE is because this is the PE ratio that is justified based on the retention ratio, required return, and growth rate. Why is this called the fundamental PE? so it's sometimes called justified, sometimes called fundamental. It's called fundamental because it's based on the company fundamentals. What is another way that we come up with the PE ratio for a company? Based on comparables. So the other way of coming up with the PE is based on comparables, where you say that other companies like this are trading at a PE multiple of 14. Okay, that's one way. But this way is based on the actual fundamentals of the company, or you can say that this is the method that is justified by the numbers, the growth rate, required return, and retention ratio of the company. So this was the PE. Can you memorize this? This is the forward PE. Can you come up with the trailing PE? How would you do that? So you would simply divide so I'll just show you very quickly, because at level 2 you need to be on top of this. Okay, so you know that P naught is equal to D naught into 1 plus G over R minus G. Then you divide both sides by E naught. So on the left then you have, so what do you have on the left? This is the trailing PE. So that's the trailing PE. You can write this as D naught over E naught. What's D naught over? Yeah, so the D naught over E naught is your payout ratio. So that you are assuming is staying roughly the same. So in this particular case, we are assuming that the retention ratio and the payout ratio is staying the same. So what number is going to be bigger? The trailing PE or the leading PE? Yeah, so always, so at least for growing companies where G is positive, the trailing PE is going to be higher. People got confused about this at level 1, but I think at level 2 you should be past that.
For the leading PE.
Okay, so let's see if we can do this quickly. So same, carry 4 example. The justified PE, what's the justified PE based on the Gordon growth model? So let's do this fast. You have your stock price is given, the trailing annual earnings per share. So you're given all this data. Calculate the justified trailing and leading PE based on the Gordon growth model. Okay. Yeah, so the 1 minus B, that is your, so B is the retention ratio, so this is your payout ratio. B is the retention ratio, so 1 minus B is the payout ratio. So the 0.32 we calculated as the, yeah, so B is the retention ratio. So 1 minus B is the payout ratios, which is D naught over E naught. So this is your payout ratio. Okay, so this is fairly straightforward. Obviously, I want that you do this a couple of times, so on the exam, you should just be able to do this without a problem. As a larger point, equity is about 20 to 30% of your exam, and I think it's the easiest topic, probably one of the easiest of the 10. So it's very hard to pass this exam without doing well on equity. Okay, so this is example 11. Nothing too difficult, just make sure you do it well. Okay, so next, just a few general points. This is section 4.7, estimating a required return using your Gordon growth model. So normally, how do we come up with the required return? Using CAPM. If you make an assumption that the market is efficient and the value is the same as price, then actually you can also come up with a required return based on what? Based on this Gordon growth model. So you might have seen this formula, the required return is equal to D1 over P naught plus G. This is just rewriting the Gordon growth model. But what you should not, so this effectively is telling you what is the discount rate which makes the present value of future dividends equal to the price. So this is technically the IRR. But what you should not do is calculate R based on on this model, and then use that R again in a Gordon growth model to come up with a price that would defeat the purpose. Anyway, the point here is that you can use this concept to come up with R, and that works if the market is efficient. Okay, the final remarks, I've taken the most relevant, important excerpts from every section in the curriculum. So the Gordon growth model is the simplest practical implementation of discounted dividend valuation. The Gordon growth model is appropriate for valuing the equity of dividend-paying companies when its key assumption of stable future dividends and earnings growth rate is expected to be satisfied. Okay, broad equity market indices of developed markets frequently satisfy these conditions. So the point here is, if you are trying to see whether the S&P is fairly valued or not, you can actually, in the S&P, if you look at all the dividend paying or the dividends that you get out of the S&P, those generally track the earnings growth of the companies in that index. So the remark here is that in general, the dividend discount model is a good way to evaluate whether an overall stock index is fairly valued, overvalued, or undervalued. Okay, that's the main point out of this particular slide.